Hello everyone and welcome back to the revisionary sessions on long-term financing decisions. This is the second part of this revisionary class. In this class we are talking about capital structure decisions. So let me remind you, when you talk about long-term financing decisions, what you have learned that there are four different sources of long-term funds: debt, preference shares, equity shares and retained earnings, and we need to make an optimal mix out of these four sources, and designing an optimal capital structure therefore becomes your ultimate goal. Now here we are talking about capital structure decisions. So capital structure decisions will definitely go with that same objective, that is having optimal capital structure. And optimal capital structure has been defined in two different ways. One is a capital structure that can maximize the rate of return on equity. Another is a capital structure that can minimize the overall cost of capital. So here we will stick to the first part of the definition, where the returns for equity shareholders can be maximized. So that is the clear objective over here when we talk about capital structure decisions. Here another two related concepts will emerge, what we call as trading on equity and concept of capital gearing. Let us one by one talk about these two concepts. What is trading on equity? Now, an entity needs to borrow money for expansion, right? When you want to expand, you need additional funds and you need to borrow. Now, whether borrowing should be made or not, whether the company should raise money from borrowings or not, completely depends upon whether borrowing in that particular situation is favorable or not. Now, when can we say that borrowing is favorable? You need to compare two things: the rate of interest that you have to commit on the borrowings, that you have to compare with the return on capital employed, ROCE, or you can also call it rate of return on capital employed, that is ROROCE. So imagine a situation that the company's capacity to generate return on capital employed is just 10% on the amount of capital employed, and if it has to raise borrowings, the rate of interest on borrowings is 12% per annum. That means it will be a foolish step to borrow money at 12% and invest it to generate returns of only 10%. Therefore, it is not a favorable situation to borrow. What could be a favorable situation to borrow? When the rate of interest on borrowing is less than the rate of return on capital employed. In other words, when the company has capacity to generate a rate of return on capital employed which is greater than the rate of interest on borrowings, then it is a favorable situation to borrow. In such a situation, when the entity is borrowing money and utilizing that as part of its capital, what will happen? It will invest that capital at a higher rate and it will have to pay interest on that portion of capital at a lower rate. That differential surplus will enhance the return for the equity shareholders. This phenomena is called trading on equity. Now, the another interrelated concept over here is the concept of capital gearing. Now, what do we mean by capital gearing? The infusion of debt as part of the capital is what we call as leverage, and that is what we call as capital gearing as well. So please understand, a company or a firm having no debt at all, it is considered as an unlevered firm, and the capital is called the ungeared capital. So unlevered and ungeared are giving same implications, but terminology wise the word gearing goes with the capital and the term leverage goes with the firm. So a firm can be a levered firm or an unlevered firm. So what is an unlevered firm? A firm having no debt at all. A levered firm is a firm that has debt as part of its capital. Likewise, when you call that geared capital is a capital which will include debt. Ungeared capital is a capital in which debt is not included. So what happens? When you find that the return on capital employed that a company can generate is less and the rate of interest on borrowing is high, it is better not to borrow because it is not a favorable situation to borrow. In that case, it is better to operate with whatever equity capital the company has, just operate at a minimal level with that capital. In that case, we call that capital as ungeared capital and the firm is considered as an unlevered firm. But when the company starts generating a higher rate of return on capital employed, and when there is a favorable situation to borrow, when you can take advantage of the phenomena of trading on equity, you start including debt as part of your capital. And when you do so, the capital becomes a geared capital. So as and when you want to expand more and more, you keep on adding more and more portion of debt in your capital, from ungeared situation to a low geared situation, and from a low geared situation to a high geared situation. That is what we call as capital gearing concept. And when you are dealing with the concept of ratio analysis, don't forget that capital gearing ratio is a very, very important ratio. Do you know what we do when you have to compute capital gearing ratio? In the numerator, you will be taking all the external sources of funds, including preference share capital. Means debt and preference share capital will be the numerator, and in the denominator, you will be taking the equity share capital and retained earnings. That means your pure equity shareholders funds will be the denominator, and the numerator will contain those funds on which you have to pay a fixed rate of interest or dividend. Now, let me give you short notes on these concepts of trading on equity and capital gearing. So based on what we have just discussed, please write under the heading trading on equity: when an enterprise is able to generate rate of return on capital employed higher than rate of interest on debt and uses debt as part of capital structure so as to maximize the earnings of equity shareholders, then it is considered to have advantage of trading on equity. And then the interrelated concept, that is capital gearing. When an enterprise uses debt as part of capital structure, then it is considered to have a geared capital, and the firm is considered to be a levered firm. In other words, if the capital employed does not consist of debt component, then the situation is considered as ungeared or unlevered situation. Unlevered firm therefore has no financial risk. Moving ahead, you may write trade-off between financial risk and profitability. For having no financial risk, an enterprise is suggested not to borrow, that is, not to raise funds in the form of debt. But in doing so, it restricts its earning capacity for its equity shareholders and cannot enjoy the position of trading on equity. In order to increase the earnings of equity shareholders, the firm will be required to have use of debts in its capital. Going ahead, you may write, as and when the proportion of debt increases in the capital, the firm switches over from unlevered situation to a low levered position, and then from low levered position to a high levered position, and then the fact prevails to increase the profitability, the degree of risk should be increased. Please refer question number 8 and question number 9 from regular class videos for developing complete understanding about these concepts. Let us move ahead and now talk about the next important concept, that is financial indifference point and financial break-even point. Now these concepts of financial indifference point and financial break-even point, very, very important concepts. Let us discuss each of these one by one. What is financial indifference point? Suppose you have two different plans of capital structure, plan A and plan B. Suppose in plan A, it is more of equity and less of debt, and in plan B, it is more of debt and less of equity. So you are taking more risk in plan B, less risk in plan A. Profitability will be more in case of plan B, profitability will be less in case of plan A. So plan A is low risk, low profitability plan. Plan B, high risk, high profitability plan. Now, what will happen when your return on capital employed is little lower? When EBIT level is lower, plan A will be better, because at low income also you can survive with plan A. When your return on capital employed increases, eventually EBIT will increase. In that case, plan B will become better. So what will happen? At a lower level of EBIT, plan A is better. At a higher level of EBIT, plan B is better. So what is happening? When you keep on increasing the level of EBIT, there will be one point where both the plans, plan A and plan B, they will result into same level of EPS, that is earnings per share, and you will find that the company is indifferent with the selection of these two plans, plan A or plan B, company is completely indifferent. That point of EBIT is considered as financial indifference point. Now what you can do to compute financial indifference point, you should first of all be very clear with the meaning of financial indifference point. Two different capital structure plans, you have to equate the EPS of both the plans and a level of EBIT at which EPS under both the plans are same, that will be financial indifference point. Now how to do this I have explained in details in my concept videos. If you are willing to get back to those concepts and learn the calculation part, please refer that video. The link of that video I have given over here. Coming to the next part of the concept, that is financial break-even point. Now this is not the usual break-even point what you compute in cost and management accounting. This is financial break-even point. Financial break-even point is such a level of EBIT where the resulting EPS will be zero. Generally what some people understand as meaning of break-even point, it is no profit no loss situation. So here no profit no loss situation is to be observed from the viewpoint of equity shareholder. When EPS is positive, it is indicating profit. When EPS is negative, it is indicating loss to the shareholder. When EPS is zero, it is indicating break even to the shareholder. That means when EPS is zero, we say that there is achievement of financial break even point. Therefore, in one line, if you have to define a level of EBIT when the EPS is zero, is considered as financial break even point. So let us write some important notes over here and then we shall proceed ahead. So under this heading, that is heading of financial indifference point, please write, while evaluating two different financial plans, a level of EBIT where EPS under both the financing plans is same, it is known as financial indifference point. And then the concept of financial break even point. Financial break-even point indicates that level of EBIT where EPS is zero. Therefore, the objective of determining financial break-even point will be to determine the level of EBIT such that the equity shareholder has no profit, no loss situation. Now to have complete understanding of these concepts, please refer question number 10 to question number 12 from the regular class videos. Alright, now let us move ahead and now talk about the next concept, that is cost of capital. Again, a very important concept within long-term financing decisions. Cost of capital. So of course, if the entity is arranging capital from various sources, arrangement of capital will not happen free of cost, correct? And the company will have to incur cost towards each component of capital. So determining cost of capital is very important. Why? Because at what cost you are arranging your capital, unless you know that, you will not be able to take decisions about whether you should invest your money or not at a particular project. For example, there is a project which has IRR of 15% and you find that you have arranged capital at a overall cost of capital of 17% per annum. Now arranging capital at 17% and investing that capital at 15% IRR will not be benefiting you at all. So one side, from capital budgeting viewpoint, you need to know what is the IRR of the investment that you have to make. On the other side, when you are arranging your capital, you should know what is your overall cost of capital. So this basically, your overall cost of capital will actually become a fundamental base for determining discounting rate in capital budgeting scenario. Anyway, how to determine cost of capital? So we have been talking about one thing, that there are four sources of funds: debt, preference shares, equity shares and retained earnings. So at the first elementary stage, what you need to do is determine the individual cost of capital for each of these sources, that is cost of debt, cost of preference shares, cost of equity and cost of retained earnings. At the second stage, you determine the weighted average cost of capital, which will be the weighted average of these individual cost of components of capital, and that weighted average cost of capital will be the overall cost of capital. So let us do one thing, let us quickly write some important notes over here and then we shall discuss these matters in details. So when you write the heading cost of capital, under that heading you write The arrangement of long-term finances obviously cannot be free of cost. Therefore, there is always cost incurred for arranging the capital. The term cost of capital can mean individual cost of a component of capital or overall cost of capital. For individual capital components, the following costs will be determined, that is cost of debt, cost of preference share, cost of equity and cost of retained earnings. Let us move ahead and note down further. Once the cost of individual components of capital as stated above is determined, the firm can finally determine its overall cost of capital. Such overall cost of capital will become the basis of discounting rate for investment decisions. Such discounting rate is extensively used in capital budgeting and long-term investment decisions. The objective of a firm will be to minimize its overall cost of capital. Cost of capital will depend upon the capital structure. Therefore, capital structure decisions are the basis of cost of capital incurred by the firm. Let us move ahead and now write about determining cost of capital. This process requires calculations in two stages. Stage 1 will be determining individual cost of each component of capital, and stage 2 will be determining the overall cost of capital. The overall cost of capital is the weighted average of individual cost of capital obtained from stage 1. Therefore, the overall cost of capital is also known as weighted average cost of capital. All the detailed concept video links have been given in the description of this same video. Please watch those important videos as and when you find it necessary.